She's already taken
She's already
it.
done
I know she's taken it before.
Yeah, she has.
She wanted to come again.
Oh, yeah, maybe she can come stick her head
She's just
in.
bored.
No, Billy's.
Circle paperclip.
Paperclip, my mind was on. I had too much chicken for lunch, I'm listening.
Uh-oh.
Paperclips.
My name is Christina Dominguez, and if I can stand without breaking my neck, we'll get through this. I'm from Affiliated Bank Mortgage in Waco. We did this class in Waco, and Z came down and she was like, "Oh, you need to come do it for our people." I've been in business for 20 years. I've done everything from closer, funder, underwriter, processor, and I said, I am tired of this office. I got to get out. And so that's what I've done, and it's been very good for me because I can see things that most LOs have never seen before. I've been there, I've done that, got my hand slapped, won't do that again, you know. But this is a fantastic presentation because there's things that, I mean, like I said, I've been doing it for 20 years, I had no idea. Little small things, so, and I know that borrowers tend to ask you guys financing questions even though you're not the financier. So it's good for you guys to know little things like this because there's always people that need help. And a lot of times it's not a hard fix. You know, people think, oh my gosh, I'll never buy a house because 10 years ago I had 500 collections. Okay, you know, it doesn't mean that. So let me know if you have any questions after this. I'm sure a lot will come up and you'll learn a lot. So I appreciate y'all coming.
Awesome.
Thank you.
Thank you, Christina. And help yourself to, Christina graciously brought some sodas and waters and some snacks, popcorn and chips and crackers and cookies and all kinds of good stuff back there. And I think her business cards and some bank information is back there too. So, and Christina will be here the whole class. Yeah, hey, and she'll be chiming in. You know, when we have questions, this is going to be a small enough class too. So if there is something that you think of and you want to, you know, go ahead and talk about right then, just feel free to raise your hand or whatever. You know, it's not like a big giant class with 30 people in it. So feel free to ask a question. But if you have a question that's really specific to, like, my client that's closing in 30 days has this, you know, late payment, whatever, those kinds of questions might be a little bit better for offline after the class, and I'm certainly available to stay if you've got specific questions, because we're going to talk about things and it's going to, you know, make you think about some people that you know that you're trying to help, or some clients, or maybe your own personal situation too. So and that's great. And that's what this is supposed to make you do, really think about that. And there will be things that we talk about today, like Christina said, like, I've been in the business, I've never heard that before, or that's completely the opposite of what I thought. And there are so many things about credit that that just work a little bit differently when it comes to the big picture today too. So make sure you have a packet for taking notes. And you know what? It doesn't have to be here. We can certainly pass this around. She brought her stuff. Yeah.
Oh.
So did everybody get to sign in real quick? We'll just pass that around.
Oh, is it?
Everybody, and then there's a packet. Some notes.
Give me some
There you go.
notes. I don't think they
Yes.
signed anything.
Yep. Okay, there you go. Yes, and so when you give me your check information there, that's how I'll be able to report the 2-hour CE credit. So,
Do we pay for that?
no, no,
Oh, thank you.
you're welcome. You're
There's
welcome.
a sign sheet.
We don't charge because we feel like this information is just really so important, and we know that it comes back to us in the long run, and, you know, in good faith, and so, hey, how are you? we needed more people in order to help the business move forward. So it's been a really good relationship. Sometimes when he is around, we teach the class together. Sometimes he teaches it by himself. But here lately, I've been the one who's doing it mostly. And that's real interesting. So today we are on Facebook Live. If you have seen our Elevate My Scores Facebook page, that's great. If you haven't, I invite you now to go ahead and grab your phone and go to Elevate My Scores on Facebook, because when you do, you'll be entered into a raffle, and we're going to raffle off this cute little Arctic mug today. Everybody needs another mug, right? For keeping your coffee warm in the morning or your iced tea cold in the afternoon. But I'll be able to go see all of the new likes on our page today, and I'll drop your name in the hat for a drawing for that. So appreciate it. But the other good thing about being on Facebook Live today is that this video is in our feed. So you'll be able to go to our Facebook page and see the video. If you have any questions, if something comes up that you want to know more about, or what did we say about that, you can go back and archive our video. But then also by liking our page, you'll be able to see upcoming events that we have. If there are any other classes that you'd like to recommend to a friend, or if you want to send a client over to our There we go. All right. So why do you see 3 scores on a mortgage credit report? I'm assuming you guys have looked at a mortgage credit report before. So why are there 3 scores?
3 different
Don't they take the median of the three?
activities.
They take, okay, they take the middle of the 3, yes. Right, that's called the mid-score.
Getting an average.
So they could get an average, okay. Where did the 3 scores come from? Do you remember? The bureaus, right, okay. And they're called?
Equifax,
TransUnion. And one more. Experian.
Yeah.
Good, okay. So there are 3 scores because there are 3 different reporting bureaus, 3 different reporting agencies: TransUnion, Equifax, and Experian, right? Okay. 3 different bureaus that are repositories for information. They hold information about you, right? About the things you're making payments on and that you have made payments on in the past, that kind of thing, right? But why are the scores different? Why aren't they the same?
Different criteria for whatever is being considered.
Okay, different criteria for whatever is being considered. Yes, okay, that's part of it for sure. They have a kind of a different formula. Any other thoughts about that?
Different reporting times.
Different reporting times, yes, that's definitely a part of it. So different creditors report to different credit bureaus. So when you're looking at a credit report, you're going to see maybe you have a medical collection, and that's only reporting to Equifax and TransUnion, right? And then maybe you have a credit card, and that's reporting to all 3. And then maybe you've got something else that's only reporting to TransUnion. So if you layer that over all of that, then you're going to have some differences in the score because they have different information about you, okay? Right? Also, like you said, credit cards specifically report to the bureaus at different times of the month. So you might have like one Discover card, for example, and it might report on the 1st to one bureau, and then it might report on the 18th to the other 2, right? And what it reports on that day could be very different depending on what you've charged or what you paid, right? If you, like I know a lot of realtors do this, kind of fund your business on a credit card, right? And then the commission check comes in and you pay it down, right? And so think about just about that alone. And we'll talk a little bit later about why the balances of your credit cards really do affect your score a lot. But So if it's reporting to one bureau on the 1st and the other bureau's on the 18th, that could be really a big difference in your score, okay? Depending on what's on your card. But then the big picture reason why the scores are different is because of algorithms, okay? And an algorithm is just a fancy word that means the algebra math problem that they're using to figure out the credit score, okay? And so each bureau uses a little bit different algorithm, okay? Now, here's one of those things that you're gonna go, what? There are actually over 100 different ways to compute a credit score, right? 100 different ways to get the same answer about you, okay? So knowing that, and then knowing that most of us, when we're just thinking about our credit score, think of one number, right? That's a big difference, right? 100 different ways that of variances in computing a credit score, but we think of our credit score like I'm a 660, right? But no, not really, because you have to know what that score means, right? Okay. So now FICO is a word that we hear and we think of that gives a lot of validity to a credit score, right? So my FICO score is, maybe that's more official, right? Right? Now why do we think FICO is more official? Because FICO is the law of the land in lending decisions, right? In mortgages and auto loans and student loans, right? That FICO score, okay? Anybody know what FICO means?
Fair Isaac
Corporation.
Corporation.
Yes, very good, very good. You got all the answers. He's been to the class before. I'm just kidding. The Fair Isaac Corporation. The Fair Isaac Corporation's been around since the 60s, okay? And it's named for two mathematicians, Mr. Fair and Mr. Isaac. I think that's really interesting. And they were just guys that wanted to come up with a way to give a number that would be a way to tell the bank whether you could borrow money and pay it back, right? And so they devised this way of coming up with a credit score that was based on your credit worthiness, right? But it took until the 80s until credit scoring was actually used in the mortgage industry. So that means if you were in real estate, or maybe if you're like me, maybe you remember when your parents bought their home, they didn't pull a credit score. You just had to bring your bank statements and your tax returns and all this other stuff down to the bank, and they would like, okay, all right, here's your box, and they would lay it all out, and they would look at that to determine your credit worthiness. And so they didn't rely on that number like that and before that. So so like I said, FICO invented credit scoring, and they pretty much hold that pretty tightly. But even within FICO, there are 49 different algorithms used in FICO. So even FICO has 49 different ways of computing a credit score. So I've just told you that a credit score is not a credit score, and a FICO score is not really just a FICO score, right? That there are lots of different ways to do that FICO score. Now within FICO, there are 9 mortgage algorithms, okay, that are specific to the mortgage industry, either old ones or current ones, okay? So that means the other 40 are for other industries, like the auto industry and that kind of thing, right? So in the mortgage industry, the 3 main algorithms that you'll see on a credit report today have names. They are called Fair Isaac version 2, Beacon 5.0, and Classic 04. And those are the 3 algorithms that you'll see that are being pulled on a mortgage credit report. So when Christina, the loan officer, pulls a credit report, those are the algorithms that her credit reporting service uses, okay? Now, today, in 2019, if you get a mortgage credit report at Affiliated Bank with Christina, and then you decide, well, let me see, let's go, I heard that other place down the street was pretty good, not that you'd ever want to do that, but then you go down there and you talk to another loan officer and they pull a credit report on the same day, you're gonna see the same scores, okay? Now it didn't used to be that way. Prior to 2008, we all kind of know 2008 and what that did to the mortgage industry a little bit. Prior to 2008, you could see different credit scores from different mortgage companies, okay? So you could go be at Wells Fargo one day and get a a credit report, and then you could go to, you know, some guy at this mortgage company down the street, and he might use a different algorithm, right? That would be a little bit more lenient. There was an old one called Classic 02, there's Classic 98. So they were a little bit more lenient. They could get some loans done on those more lenient algorithms, right? But then what happened in 2008 is that, you know, the mortgage industry really had to tighten up, right? So, and mortgages are bought and sold these days, right? So the investors that are buying those loans really wanted the newer mortgages that were being written to be underwritten using those three algorithms, Classic 04 and not Classic 98, right? Because they got to be able to have that loan be valuable enough to sell, okay? So the industry has really tightened up, and so today, when you pull a mortgage credit report on that day, as long as information is the same, right, that mortgage credit score is going to be, you know, the same as well. Now, the industries that are where mortgage or where credit is used, can really change the credit scoring. So a mortgage credit score goes from 300 to 850, okay? But in the auto industry, it's a little bit higher on the top end. So you might see that that auto credit scores might be a little bit higher, right? Credit cards are another way, another industry where credit scores are used, and as well in insurance too. It's a really important thing in, like, when you're getting your homeowner's insurance with credit scores. Your auto insurance is based on your credit score. There's a factor in that pricing and that decision. So let's talk a little bit about the internet, okay? Because this is where all of us mostly are getting to see our credit scores, okay? Right? What do you guys use to look at your credit score?
I use Turbo.
Okay.
Credit Karma.
Credit Karma?
I use AAA.
So what?
AAA.
Okay.
AAA. I mean, it's, for all the members, they give it for free.
Do they? Okay.
Yeah.
I know credit, let's see, Capital One in their app, if you have a Capital One card, has a thing called Credit Wise, and you can see your credit score on that. I think Discover Card in your statement will give you a credit score as well. So that number that you see in the internet, whether it's Credit Karma or Credit Wise, Credit Sesame, or if your bank tells it to you, whatever it is, that internet-based credit score, it uses a very different algorithm. You know, we talked about those mortgage algorithms and all these other algorithms. So internet-based credit scores mostly use an algorithm called Vantage. And Vantage is sort of the internet version of credit scores, okay? Vantage is an algorithm that is not a lending score. It's an informational score. And if you have a Credit Karma account and you open it up and you scroll all the way to the bottom and look at the very bottom in the fine print, it'll say that that credit score was computed using Vantage 3.0. That's the name of the algorithm, okay? Now, why is this important? It's because I want you to understand that credit scoring is, although it's so important, it can be very subjective. So that Credit Karma score that using that Vantage algorithm that says 640, right, is not necessarily what Christina is going to pull, right? So when Christina pulls a mortgage credit report and says, well, the mid score here says 605, right? Right? But Credit Karma says I'm a 640, right? Is what your buyer is going to see, right? Okay? But generally, that Credit Karma score is 30 to 40 points higher than the mid score on your mortgage credit report, okay? As a rule of thumb. Sometimes it's much more, and sometimes it's pretty close. But just on average, that's kind of what we see. And so we're looking at those credit reports on a lot. So, there are times and exceptions where it's outside of that, but that's a good rule of thumb. So if you have someone and you ask them about their credit, well, what do you think your credit's like? What kind of items do you have on your credit report? Well, I think my score is a 620, so we should be good to go. Like, well, maybe we should go talk to the loan officer first and just see where you are, right? So that's just important to know, right? And the big reason is that a mortgage algorithm produces a lower score because it's based on your ability to pay back a mortgage, right? And that's the thing you can tell your buyers too, right? It's not that they're wrong and Credit Karma's right, okay? It's that score tells about your ability to pay back that largest amount of money you'll probably ever borrow in your life, right? So it's different. And then people go, oh, okay, I get it now, right? That makes sense, right? So an auto credit score is based on your ability to pay back a $25,000 truck loan, right? And a credit card score, right? So you have to know the source of the score and to really understand its impact and its meaning. Does that make sense? Were you gonna ask a
No,
question?
that makes sense. What do we do? The mortgage-based scores are totally different from the internet-based, so how
Mhm.
it is computed is a lot different.
Yes.
So that makes sense. That was my question.
Yeah, absolutely. So I answered your question.
Yeah.
And I didn't even know it, right? Okay, yeah. And I'm not saying that Credit Karma is bad, not at all. Because if you look at Credit Karma on a regular basis, you can see a trend, right? Is my score going up or is my score going down, right? And they show you two bureaus of information, right? They show you TransUnion and Equifax. They don't show you Experian, okay? So just to know that there could be something that Experian says about you or doesn't say about you that is not on TransUnion and Equifax, okay? So just understand the source of the credit score and know that that loan officer, didn't mess up your client's credit score when she pulled it, right? And it was 605, right? It's not her fault, right? Help them to understand with just that little bit of education. I want to warn you before you go in that your mortgage credit score could be lower than your Credit Karma, and don't panic, right? Take a breath and then let's take a look at it and see what she recommends. So yeah, okay. Any other questions there?
Have you ever used annual credit report?
I know that people have done that, yes.
Okay.
And there are some benefits to doing that. It is a service of the credit bureaus, right, to get your free annual credit report. But what you don't know when you sign up for annualreport.com is that in the fine print, you are signing away some of your investigation and disputing rights and giving the credit bureaus a longer period of time to resolve disputes and investigations.
Which one is that?
If you go to annualreport.com, the free one that you can get every year, in the fine print, you are signing away your and giving the credit bureaus a longer period of time. So
Forever? Or can you go back and say?
Yeah.
For that
Probably for that year.
For that year.
So you can't.
But you
So that
can
means if you
because
get
it's
annual
you
report
get one
done-
time to pull free.
Yeah, if you get your annual report and then that within that year, and you sign up or if you try to dispute or investigate items on your credit report, now the bureaus have 45 days to resolve that investigation before they have to answer.
But it's not that way with Credit Karma?
Credit Karma is, no, because it's just informational.
Yeah.
Yeah, and it's a soft inquiry. So, and we'll talk a little bit later about credit monitoring, about we've got a program that we recommend that we think is pretty good. But bottom line is you might have to pay a little bit in order to see a complete 3-bureau credit report. And it might be worth it to you if that's something that you're trying to work on. Okay, so let's talk about the mortgage FICO scoring model. This pie chart here, and it's in your packet, so if you want to take some notes and everything. There's 5 sections to that algorithm, to the formula, okay? With different percentages for each, and we're going to break down each one and talk about how and why it affects the overall score and some things that we have learned in our time of helping people with their credit. So the biggest section of that algorithm is the 35% section that is payment history, okay? So this 35% section is the payment history of all of your open and active accounts, okay? So everything that you're actively making payments on, like credit cards, student loans, your mortgage, your car loan, signature loan, anything that you're making payments on is calculated in this section of 35%, okay? This 35% section is also where all of your negative information is collected too. So any late payments, any collections, charge-offs, bankruptcies, anything like that is calculated in this 35% section, okay? All right? So in this section, months reviewed is an important thing to understand. So when you have an account and you have activity on that account, okay, like an installment loan that you may have to make a monthly payment on every month, right? Like your student loan, for example. So every month that you make that regular monthly payment, you're increasing the months of review for that account, okay, right? And then say you're going to pay on your student loan for 10 years, right? So you're going to have 120 of months of review by the time you get done with that. That's actually really good for your credit score, right? Now, you may get out of school and look at 10 years of debt, right? I don't want to do that, right? But in the long run, making 10 years worth of regular monthly payments is going to really help you grow your credit score, right? And this is one of those things that is sort of counterintuitive. That it's not that, that having debt, helps you have your credit score, but it's the regularity of the faithful monthly payments, that kind of thing that really helps you here, okay? When you have a credit card, every month that you have activity on that account, it counts as a month of review. So if you have a card that is in the back of your wallet, that you're saving for that day when the hot water heater goes out, that kind of a card or something like that, right? And you're not really using that. You're not helping your months of review. So a little bit of regular activity on your cards can help boost that number and help that trade line help you to grow your credit score. Now, just to back up a little bit, when I say trade line, do you know what I mean by a trade line?
No.
Okay, so a trade line is just an account, okay? Like your student loan is a trade line. And when you look at a credit report, it's reporting on across the bureaus, right? So any account, medical collection or credit card or your auto loan, those are trade lines, okay? Basically anything reporting on your credit report is a trade line, okay? And if I use the word installment account versus revolving, do you understand what I mean by the difference of those two?
Say it one more time.
Installment or revolving, do you know the difference in the?
Credit card is a revolving.
Yes.
So you just pay back and use it again.
It's like a revolving door at the fancy hotel, right? The money goes in and the money goes out, right? And you can just, keep doing that over and over again, right? Charge up $1,000, pay it off. Charge up $1,000, pay it off. You can keep doing that, right? But on an installment loan, right, you take out a $30,000 vehicle loan, right? And let's say you get it paid down to 20, right? And you think, oh wow, I could really use some new rims on my truck, right? That'd be great. I'll just go down and borrow back against that trade line, that line of credit. I don't like that, right? No, you can't do that with an installment loan. You just have to keep paying those installments, and that's that. Once you access that credit, that you're done, right? You just have to keep paying until you get it done, right? But that's the difference in how those work. Okay, so this is where. Closing an account, one of the places in your credit score where closing an account could affect you, okay? So let's say, in fact, I looked at a credit report today, some people that sold their home, right? And they've been paying on their mortgage for a while, and they're going to kind of be homeless for a few months until they get to their next thing. So what happened is that the mortgage that they had previously is now closed, right? So guess what? It's not reporting in that 35% section any longer. So all of those timely mortgage payments that helped them to grow their credit score, now that has dropped out of this section of the scoring model, right? It's still on their credit report, but it's not helping them here like it was before, right? Does that make sense? Because it's not open and active any longer. So that could be a factor in just understanding why a score might drop like that. Yes?
Okay, so I sold one of our homes, so
Mhm.
you're saying that, so we were assuming that since we don't have that debt anymore, that it was gonna help us, so it may not, or?
Well, so let's remember that in qualifying for a mortgage, your debt to income ratio is a factor, right? And Christina can tell you all about that, right? And your credit is a factor, but they're not equal, right? They're separate indicators about, right? You know, so you have to, you know, you did help your DTI, right? But you may have affected your credit score some, right? So it's just something to understand the impact of it, right? It's a scale, right? Right. And if you want some help in kind of looking at the big picture, you know, a loan officer is a great person to just sit down and say, well, what would happen if I did this, you know? And we see too, you know, people that say, hey, you know, I've got some money, I can go and pay off my truck, right? You know, I've got like $6,000 left and we're just gonna pay it off, right? Right, well, what if you waited until after closing to pay that off, right? Instead of before closing, because they might see a drop in your score once that account closes and drops out of the section, especially something like an installment loan that you've been making lots and lots of monthly payments on. So just something to understand, you know, especially when, you know, that credit card that you've had forever that really makes you mad and, right? And you say, I'm going to start using this new shiny one. I like this one better, right? Because Chase made me mad, and then you close that account, right? And you lose that payment history. It also affects you in another section of the credit score too when you close accounts, so.
Let me put
Okay,
something,
yeah,
add something to that. There are programs, because there are situations where people's DTI needs to come down. But what we do is have them pay it at closing if they need to pay something off for the DTI to qualify. Because, like she said, if I need the guy to pay off his $2,000 note at the bank and he pays it off, and 2 weeks later we're closing, I mean, his score could change dramatically. And so that's why we tell people, don't open, pay things off, don't do any of that unless you check with us first. But if it's something where you need to qualify, you just do that at closing. There's certain times you can do that at closing.
So that increases, your debt to income ratio?
Yes, sir, if you pay something off, yes.
And you can do it at closing?
Yes.
Yes, not on every situation.
Right, but that
there
is
are-
one vehicle.
Yes, yes, sir.
I mean, it's a good what if, you know,
Yeah,
and to have
that's
someone,
pretty good.
you know, in your ballpark that really understands how that can happen and, you know, and not be stuck like, oh my gosh, you know, my credit score dropped 30 points, yeah.
So what if I have a credit card and I don't want to use it, I just pay it off and can I just hold on to it?
You're not doing yourself any good because it wants activity on
I'm a
it.
bad customer for
You're
credit
a
card.
very bad
Yes.
customer.
You're
Well,
not helping your score.
in that
I'm
case,
not
you
helping the
know,
economy.
well, and you know, I'm not here to make you geek out about your own score because chances are your scores are probably really, really good. But you know, in a situation where every point matters, you know, if you're trying to get from a 719 to a 720,
Right.
that could make a big difference, right? You know, just go out and buy a tank of gas on that card, right? And then it would help the months of review, right? So, you know, and Christina can tell you that one point where you're on the threshold, you know, could really make a big difference in interest rate or other things available to you. So, you know, a good idea about that is maybe to put a small little trickle of a charge like your Netflix bill or something on one of those cards, or your toll if you're in an area. I know down in Austin we have tons of toll roads, but your toll account, you know.
Is it an auto pay?
Yeah, and leave it on auto pay and pay it down right before the due date. You shouldn't really see, you know, it's about using credit as a tool, you know, to help you grow your score.
I always tell people in that situation, you know, I do know people, they're like, they want their points or their mileage or whatever their reason is, and so they have, all of their bills are debited from their credit card, and then they just pay it off at the end of the month. Don't, maybe leave $20
yeah.
as a balance. maybe send every bit of it in but $10, $20. When I run the scenarios and stuff and look at people's score, I find that if they need to pay something off, if they leave $10, that's the magic number for whatever.
It is. You're not the,
It
you're,
really is.
I've had so many loan officers say that, to leave $10 on there.
It is the magic number for whatever.
So the credit card companies don't want to know that you can pay off everything.
Yes.
Right. And that's a great segue into the next section of the credit score here. Oops, I'm hitting the button too many times. There we go, 30%,
They won't
okay.
give us any more money if we pay off everything. No credit line increase anymore.
Yeah, well,
Yeah,
but remember, your credit score is about your ability to use credit, right? And so
Right.
you do need to have that activity on
No,
there.
but can I
So-
go back and ask them for a credit line increase
Yes, you can.
if I pay off?
Yeah, absolutely.
Okay.
In fact, that is something that could really help you in this section right here, because if you go from a $2,000 limit to a $10,000
Right.
limit, right? That increases what we call the utilization for you, okay? So this next section right here, 30% of your credit score is all based on utilization, which is how much you, of a balance you have on that card, right? So it's the balance versus the limit. So if you have a $1,000 limit and you have a $900 balance, your utilization percentage is 90%, yep. If you pay it down to $200, then your utilization percentage is $200 versus a $1,000 limit. Like, I didn't think there was gonna be math today. 20%, right, okay. Sorry, didn't make you have to do math in your head.
We have calculators.
Right, so the higher utilization, the lower amount of points that you get in this section, okay? And the lower utilization, the more points you get in this section, okay?
Added to your score.
Yes,
Why would I get, and that's probably, just answered in the last portion, a notice that my credit score dropped for not utilizing.
so was it a time of inactivity, maybe?
That may
Okay.
be it.
Right.
Everything's paid off, so
Right,
I
so-
haven't been using it.
And sometimes, credit grantors, credit card companies will close a card due to inactivity. Sometimes a lot of the store accounts, like Home Depot, that kind of thing, or Bells or whatever, they might close an account due to activity. So when that drops off, then you could see your score drop a little bit, yeah. So here's the big picture though. Imagine that if I took out that whole section right there, right? It's like getting your pizza and there's 2 slices missing, right? If you don't have any open active credit cards, you get nothing in this section. And how many potential home buyers do you have that say, I don't have any credit cards, I don't believe in credit cards, I'm gonna get in trouble, I don't want it, right? Yeah, uh-huh.
I'm sorry, to go back, so if you have $1,000 credit limit, so you're saying the lower your balance is, the better the score is, okay?
Yes, but if you have no credit cards, you get nothing.
Yeah, okay.
Here, right,
You want
Yeah.
credit cards, but you want
So-
little ones.
yes.
Yes.
So if you don't have a credit card, you're not gonna get any points in this section. That means out of 850 points, the highest score you could get would be right around a 600, right? And so sometimes, that first, a bit of credit counseling that a loan officer might do, or someone like me, is
I
to
didn't know
look and
that.
say, what, do you have an open active credit card? If your score is a 520, like, well, no, I don't, but even if they've said, well, Dave Ramsey said I shouldn't have a credit, like, whatever it is, and not that that's bad, but you need to show your ability to borrow and pay back small amounts of money, and a credit card is a good way to do that, okay?
What if a buyer says, I don't care about credit cards, I have cash?
Well, then that's completely,
Or
that's a
why-
completely different matter, right?
Because why do I need a card?
Right, absolutely. A cash buyer, it's not an issue, right?
They can do whatever
Right,
they want.
right. Yes, not an issue. But if you're borrowing money to buy a home,
Only if
right.
you're borrowing.
Yes, if you're borrowing money to buy a home or a car or getting a student loan, whatever, right? Then that is the issue, right? Okay. So, now each card that you have that's open kind of has its own effect. So there is an overall, combined average of utilization, but each credit card by itself kind of has its own effect on the score. So, now this is an opportunity where loan officers very often will look at a credit report and say, hey, you got this $5,000 credit card and it's got a $4,700 balance, right? That's pretty high, right? And it could be that maybe it reported on the day after they made all their payments and bought their groceries and everything for the month. Who knows, right? Or maybe they had to go, repair their vehicle and make a, big payment. But if they got that card paid down to that 20%, and I say 20% because that's kind of the sweet spot that we see in utilization, that you can get the most points back. So if they paid that $5,000 limit card to $1,000, then a loan officer can say, hey, your score is going to go from here up to here just by making that payment, right? So, and it may be a small card. It may be a small, like $500 card that's got a $450 balance. That's 90% utilized. Well, hey, let's pay that down to $100, and it could help your score because it's that percentage of each card. Okay, so this is often an opportunity for loan officers to help someone get to the next tier of credit, or to go from non-qualified to qualified just by paying down the balances on their credit cards. So, right, Christina?
Yes.
Yes, it's often one of the first things that they can coach a borrower through, right? So, okay.
There's a gray area there.
Mm-hmm.
If you got a decent credit score,
Mm-hmm.
and you're not using the cards that you have
Right.
or what have you.
Uh-huh.
And that's what I was talking about when I said my credit score went down.
Right.
It didn't have much room to go down, and it dropped it.
Right. Well, and technically, and it's really funny because in this section right here, 0 utilization is not as good as like 1% utilization. And I don't know why, and that's like Christina says, that magic number is $10. But for some reason, you get more points in this algorithm if you have a $10 balance than if you have a 0 balance.
Yeah.
So that's just something, to, like, if you are trying to increase your credit score so you can get from, A to B, and every point matters, that might just be something that you try, charging a little bit on the card and see if that does help.
I'm talking 10 points
Yeah.
from the top.
Yeah, yeah,
Sometimes 10 points makes a world of difference.
sure
Yeah,
does, yeah,
I
yeah.
would feel every point makes a difference.
Yeah, yeah. Yeah.
And that's what I'm trying to,
Mm-hmm.
how come I can't hit the ceiling?
Are you going for the ceiling?
Are you going for
I'm going
Call me
for-
when you get it, because I've never seen it.
the highest?
Well, I was at 145.
I've never seen the ceiling. Have you seen the ceiling?
We've seen, no, I don't know, our highest credit
I
score
mean,
we've seen,
845.
we've seen 835.
I've seen 836.
And we've seen, and it was somebody that had an American Express they'd had open since, 1970, and a Shell gas card that they've had that long,
And that's
a mortgage that they've paid on for 20
That's
something
me.
years. Yeah.
That's
yeah.
me.
Yeah.
And I
Mhm.
can't get the 850. I got 840 now.
Congratulations.
And but they're killing me because
They're not killing you. They're not
Let
killing
me just
you.
say, that's what you call first world problems right there.
I know.
That's a problem I'll take all day long.
But when you look at that credit report, there's always a reason, yeah, there's always a reason at the top that you don't have an 850, right? When you look at that credit report, they'll tell you a reason code, and it might say, no, not enough activity. Yeah, no activity, yeah, for sure. So,
my American Express is 30 years old.
yeah, yeah.
You gotta go to dinner
Pay
and
down
eat your
all
car.
balances, so they don't give you any more money.
Now, see that?
Okay, let's talk about this next section, which is 15% of your credit score is the length of history. So this is a straight up average of all of your open and active accounts, right? Okay, and in order to maximize this section, you need 25 years of average credit histories, which is why the people that have 800 plus credit scores are those who have had a gas card for 30 years, right? Or, because you might have a credit card for longer than you have your mortgage, right? Certainly your auto loan or any other type of loan, right? So those accounts that you've had for a very, very long time can really be an asset to you. And consider them that way because they will help to grow your credit score, okay? Now, did you know that there was a pretty easy way to manipulate this section by becoming an authorized user? Have you ever heard of that term before? An authorized user?
Yes.
Okay, so it's someone who you grant access to use your account, right? And then they inherit all of the history of that trade line. Yeah. So for, parents very often do this for their kids, right? To help give them a credit score on an account that they've had for a while, that has a low balance, that's had regular monthly payments, and, that nice length of history, right? So they add their kid that's going off to college as an authorized user, and bam, now they have a really good credit score, right, based on that. So it is something that could be a factor. Now, be careful about being an authorized user, because I looked at a credit report today where we're actually recommending that they get removed as an authorized user because there was a recent late payment. And it wasn't a big card or anything, but it was one of those things that happened. The automatic payment somehow didn't go through on the right time, and it's just a fluke. But still, it was an effect to the credit score. So our recommendation was just call up the card company and get removed as an authorized user, right? And then that would help increase the score. So that's something to know. Now, a lot of questions that people have about authorized user, like, well, do you get everything from their credit report? And no, it's just that one account, So it could really be something that could really be beneficial, right? It doesn't affect the person who grants the authorized user status.
Okay, unless they don't make the payment.
Right.
And that's why I keep them, I don't send them to, I got 2 authorized children with.
But they don't
American
have a card,
Express.
right?
Right, I got the card.
Smart daddy. No, that's exactly right. They don't have to have the card, but they
Right.
have the credit history,
Right.
right? Yeah, absolutely. Absolutely.
You
no-
can make me one of your
Okay.
Yeah.
Start
There's-
going this direction.
There's actually
Zigzag.
there's actually a whole little industry involved in selling trade lines where people have somehow collected credit card accounts, and they sell the ability to put you on there for a certain period of time. I don't know, it just doesn't seem like a thing that you should charge someone for, but anyway. So this is another section where closing accounts, can, like we talked about, could be a factor, right? Now, let's think of a situation where maybe somebody has just recently opened up a lot of new credit cards, right? So their length of history has gone down, right? Their average has gone down. Because let's say maybe they had a Chase card and a Capital One card, but then they went and opened up a Home Depot and a Target and a Old Navy card and all these other new credit cards, right? So now their average history is really much lower because they have all these new accounts. So in that case, closing a couple of those newer accounts could help them, right? So I don't want to say that closing an account is a bad thing or a good thing. It really depends on the situation, right? And if you're trying to increase your length of history average, you want to look at how many years, months, or whatever that you have those accounts, right? This is also where depth of credit can be beneficial. And what I mean by depth of credit is that you have a few accounts that are open and active, okay? So if you only have one credit card, right, and then you get one more, right, you're cutting your average in half. But if you have 4 credit cards and you get one more, that new one isn't going to affect the average as much because you have depth of credit, because you have several things on your credit report. Does that make sense?
I need you to repeat that.
Okay, so depth of credit is where you have several open and active credit cards. Let's say we have 4 credit cards, okay? and your average history is like 5 years. If you add one new credit card to that, you're not gonna hurt the average that much, right? But if you just have one
Right,
credit
okay.
card for 5 years and you add one new one, now your average is half, right?
Yeah.
Right, to kind of do the math, right? 5 divided by 2 instead of divided by 1, right? And so that's what I mean there. So, you know, we've all been at Kohl's and they tried to talk us into getting the card so we could get the coupon to buy the thing, right? The shoes or the purse or whatever that was, right? So, you know, just be careful and understand how that will impact your score, right?
And you guys know, please tell your people, don't open new accounts. I mean, it makes a difference. I had a closing on Friday. It was a cash out, so we don't fund until tomorrow. Any kind of refinance, you know, there's a 3-day right of rescission. He left closing and went to Academy and opened a card. We don't have a loan anymore. We're starting over.
Oh, no.
Because you have to add a debt. I have to redo everything, send it back to underwriting, get him reapproved, and now he has to close again. I mean, it makes a huge difference. It really, really does. Now, there are people that have called me and said, hey, I have to buy a new car. I have to do this. Okay, let me look at it, you know, and then we'll go from there, but please make sure they know. It's not, don't quit your job, don't pay off or open.
When that
Understand the
happens,
impact.
How long does it take to do the loan again?
Well, it just all depends. I mean, we're in the middle of summer, and so what are turn times? Does my underwriter have 5 loans on her desk or 15?
Okay.
You know what I mean? Do I have a relationship with my underwriter where I can say, I need you to do this now? Yes, I do. Does everybody? Not necessarily. You know what I'm saying? So it just depends. You know, because now it has to go not only back to the underwriter, it has to go back to the processor, underwriter, closer, drawer. I mean, you gotta go all the way back through. And now you have to do the 3-day CD again. I mean, so you're not closing in the next day or two. You're just not. So things like that matter greatly.
Yes, yes. But unless you're at the beginning of the process and
Right.
you have no open active credit card and Christina says, go open a credit card.
Right.
Right. So do what she says. 'Cause she knows. Right. Okay. The next section is types of credit. So 10% of your credit score is based on the types of credit card that you have. So you can't have too much of a good thing. You can't have too many store accounts, for example, right? We've seen that as one of those reason codes on a credit report before. And as we got to look on this particular credit report, this client had 25 open active store accounts. She was a shopper. And they were all paid on time. They were all being used. So she could, you know, say, well, yeah, I went to there and Victoria's Secret and, you know, it's like she'd been to all of that, right? And for the coupons, right? The deals, right? But to the underwriters, it looked like she just really couldn't control her shopping, right? So we wanted to get that reason code to fall off to help her in this 10% section, but we didn't want to hurt her length of history, right? We wanted to actually improve it. So what we did is we were able to look at the length of history of those 25 store cards and strategically kind of come up with a plan keeping open a certain amount of the ones that she had the longest amount of time, right? And so that increased her length of history and then was enough to you know, drop down and get that reason code to come off that where she wasn't being hit in this 10% section.
How long does that take for it to jump up to where you need it?
It'll just be another reporting cycle.
So like another month or something?
It should be, yeah, 30 to 45 days, just kind of depending on each account where they are in their billing cycle. If you close it and they just reported to the bureaus, it could be another full 30 days, right? So, because that day that the credit card company reports is a snapshot of you on that day, right? So it can change. So, we've also seen a reason code that pops up on this section that was called, that said too many financial accounts. So a financial account is like a signature loan or a personal loan, but a lot of people do that, do them cyclically. Like they go down and get one of those, like a payday loan or, you know, speedy cash kind of a loan. You know what I'm talking about? One Main Financial, the super high interest type of loans. and they pay it off, and then they go down and get another one, and they pay it off, and go down and get another one, and they pay it off. And even if they're paid on time, never been late or anything like that, but if you're in the habit of getting that little signature loan every quarter, right, and you just see a series of that on a credit report, what does that look like to an underwriter?
You're struggling.
You're struggling, yeah. Yeah, you can't live within your means, right?
And on those payday loans, you know, they go in, they say, oh, you can refinance and get $100 back, you know, cause whatever you paid in, they'll let you back. That's a whole new loan. They close that one and they open a new one, and so it's
Yep.
just
Yep.
on and on and on and
Mhm.
on.
Yes. So, and I have a feeling that those are often marketed as something that will help you grow your credit, right?
They are. I
They
hear that a
are. I hear
lot.
that a lot, yeah. And it does not,
Mhm.
right? One and done, wouldn't hurt you too much, but, you know, a cycle of them really looks bad, so. A good mix of types of credit is a ratio of 3 credit cards to 1 installment loan, okay? So 1 credit card is good, 2 is better, 3 is best, right? More than 3 doesn't hurt you that much, but if you get into, you know, way more than that, it can be something that could drop your score in this section.
Is having a business card considered as a personal?
Well, is it tied to your business? Do you have a EIN for your business?
Yes.
And the card is
In my-
utilizing?
The card is in the business name, but
Mhm.
I'm the authorized user on that.
Mhm.
So it still
Or I
reflects on
could
him
be-
though, doesn't it? Cause it pulls, you have a business account, it usually works on your personal.
Well, it
Depends on how you
depends.
did.
Right.
Depends on how you structure it. You can have an EIN, like a tax ID for your business,
Yes.
right? And then the business qualifies, you know, after a period of time can qualify for business credit and could get a business credit card, like a Office Depot card or a MasterCard or whatever. And a person that works in the business can be the authorized user for it. But if the business, then that would help the D&B number, right? That would help the business to grow their business
No, but
credit.
if I apply for a mortgage, so how
Mhm.
will it affect? Because, I have a business with a EIN number,
Mhm.
I'm the officer of the company,
Mhm.
and I have a personal credit card.
Mhm. So I would say your personal credit cards are helping you to grow your personal credit
Right.
to apply for a mortgage, right?
Okay, so they're two different
Right,
things.
they are 2 different things, yes. A lot of times business owners are though not doing that and they're financing their business on their personal credit. We see
Right.
that a lot.
Right.
A lot of times people are struggling with the availability of credit for their business, but it's because they're working on their personal credit limits and not necessarily a business credit limit. Which if it were built and structured, you know, in a credible way, the business could get a lot more credit than a person can, right? There's a whole part of our business that we're working on growing now and helping business owners coach to get personal credit. But it sounds like you're already on a good path there, so, but yeah, they do operate separately.
Okay, thank you.
Yeah, no, it's a good question, very good question. It kind of runs together in our head though, right? Okay, the last section of the mortgage FICO scoring model is new credit. So 10% of your score deals with new credit. And the reason why this is a thing is because the highest rate of default happens within the first 90 days of opening any kind of account, whether it's an installment or a credit card. Okay, so after 90 days, then of activity and payments and that kind of thing, then that rate of default goes down. So they will relax some of the hit that you had. So when you open a new account of any kind, you'll see a little bit of a decrease coming from this section, okay? That's just the new credit, right? And then after 90 days, 3 reporting cycles, then that kind of drops off, all right? The other part of this section deals with inquiries, all right? So an inquiry is just where you look at your credit. There are 2 types. There are hard inquiries. So that's what you do when you're applying for money or for credit, right? And then there are soft inquiries. A soft inquiry is informational, right? Like Credit Karma, that's a soft inquiry, right? It doesn't you're not applying for money or credit, okay? So a hard inquiry drops your score anywhere from 3 to 5 points per inquiry, okay? So every time you're applying for something, you can see your score affected anywhere from 3 to 5 points per inquiry, okay? Inquiries stay on your credit report for 2 years, okay? They will affect your score for up to a year in that 3 to 5 points. Now, the greatest impact of them on your score is the first 6 months. Obviously at first is when you're going to see that 3 to 5 point hit, and then when we get to about 6 months, it's much less, and then completely not affecting your score by the time we get to a year, okay? Although they're still reporting on your credit report for that second year, they don't affect your score after that time, okay?
How does it work if I think you mentioned this last time, but I forgot.
Shopping windows.
Yeah.
Yeah, let's talk about shopping windows. Okay, have you ever heard about somebody talking about a shopping window before? So a shopping window is theoretically a consumer's ability to shop around in a period of time for a product like a mortgage, right? Okay, or an auto loan or a student loan. Okay, those are the 3 industries where there is theoretically a shopping window. Okay, if you go to the CFPB website and look up shopping windows, it'll tell you there a little bit about that. Okay, and it's to protect the consumer, so they should be able to, go look and find the best fit, right, for those products, right? Okay, so mortgage companies, loan officers use a credit reporting company or agency like Credit Plus or something like that, Credco, there's lots of different ones. And when they pull a credit report, it's coded as a mortgage inquiry, okay? So whether you're at Affiliated Bank Mortgage or another mortgage company, that mortgage inquiry will be coded that way. So all of your shopping for that mortgage in that shopping window should condense to one inquiry. So if you go to 5 mortgage companies within that shopping window, then it should count as one inquiry. Does that make sense? Yes. Okay.
How long is that window usually?
We say 30 days.
That's what I normally say.
Yeah.
30
Mhm.
days.
Is that only for mortgage or could be for anything? I can
It's
shop
not for anything.
Just for mortgage.
It's very standardized for mortgages, as long as it's reporting as a mortgage inquiry. In the auto industry, it's not as standardized, but there is an auto shopping or shopping window, as long as they're all coded as auto inquiries. Okay, so sometimes when you go to the finance department at a dealership, you guys have been there, right? And you're doing those inquiries and stuff. Sometimes they might be sending your information out to like auto financing companies like Toyota Motor Credit or Capital One Auto Finance that only do auto financing, right? But then they also might be sending your information out to like the local credit union, right? Right?
Sorry, so we say that again?
So when you go buy a car in the finance department and they kind of blast your information out to try to find you the best rate. Some of them might be auto companies, some of them are not. Some of them are financing institutions like Ally Financial or credit unions that do other types of lending. So when those inquiries go out, it might say financial instead of auto. So a good example of this is we had a loan officer that we worked with said, hey, I've got a credit report here. This guy went to buy one vehicle at one dealership, right? And he has 14 inquiries on his credit report, and his score dropped 35 points. And it dropped him, out of being able to, qualify for that loan program that he was trying to get, right? What happened, right? I thought there was a shopping window for vehicles, right? It should have just been one inquiry, right? So we started to look at the coding on the inquiries. 4 of them were coded as auto inquiries. The other 10 were coded as financial. So 35 points, the 4 condensed to 1 and the 10 counted individually, so that he was seeing the effect of 11 inquiries from that purchase.
Get that fixed.
We did, yes, yeah. But, that's just to tell you that, and that happens a lot. We see that a lot.
Happened recently to us too.
Did
but
it?
I don't know if it was marked financial or
Did you see your scores go down quite a bit, or?
I don't know, it's my husband's.
Okay, well, I mean, it'd be a good thing to check,
Yeah.
right? And maybe a good reason to have some financing ready before you go, you know, so you can say, yeah, we're good, you know, already been to the credit union or whatever,
We just
right?
didn't feel like going anywhere else.
Yeah, I hear
We're like,
ya.
we could do it here.
Yeah, okay,
So that
Otherwise we
being
would've
Yeah.
said,
went to the bank.
we're gonna go and actually go look for a car. So
Okay.
how do I prevent that from happening?
you could
Or
ask
can I?
them, if you
Yeah.
want to use their financing and you kinda know what your scores are, you could tell them, hey, just, you know, maybe run a couple, and then they'll try to convince you, hey, well, you know, it's great, we'll try to find you the best
So
rate.
do I just say view auto inquiries, not,
Mhm. You can,
what was the other one called?
Financial.
Financial inquiries.
yeah, yeah,
Do they have the option?
you know, I don't know, I think they do,
So we can request
They ought to
them to
know,
do-
right? I'm sorry, go
they
ahead.
should.
Yeah, so we can, I'm with you on that, because, you know, I'm shopping for a new car.
Mhm. You know what, honestly, and I don't wanna talk bad about dealerships, they may or may not know what
Right.
they're doing when they do that, honestly, they may just be doing what they've been trained to do.
Right.
And they may not understand the impact of that to your credit score. But I can tell you that if you go to, you know, if you have a bank that you deal with that does auto financing, or a credit union, and get pre-approved there for an amount and take that letter with you, then you don't need to worry
That's
about
what I
that.
always do, cause I always, you know, you fill out the form in their office, that's what they do, they send it out to 20 people. And if you're somebody with marginal credit, it might be 50 people.
Mhm. And if you're working on potentially, you know, and if you're really needing to make sure that you hang on to all your points,
Yeah,
I would be careful
okay.
and just understand, you know, unless it's someone that you're working with that does really have a good understanding of that, but that could be iffy, so, okay.
Did the people that you fixed get the loan?
They did, yeah, they did. But you know, we had to kind of go in and do some work on that. So this is kind of the halfway point in the course material. So we'll take a little stretch break, let everybody get up, and I know you probably got a phone call to answer or something like that, or a text message to send. Get a snack. If you haven't found our Facebook page to like it, remember to do that, because when you'll be entered into our little drawing. And so let's start back at 2:15. Does that sound good? I've got 2:08 on my watch right now. Yeah, okay, all right. And then when we come back, we'll talk about building credit, collections, negative things that are on your credit report, so. All right. turn the microphone off. There we go. Now we're back on. Okay, let's talk about building credit. What you need to do to build your credit from scratch if you're just starting out or rebuilding after a period of, recovering from some bad credit. So you need to have 2 to 3 revolving accounts and 1 installment loan, like we talked, right? That's the good mix of credit. So how do you get a credit card though if you don't have a score, right? It's kind of like this, circle that you just can't get out of, right? So what are you gonna do? There are types of credit cards called secured cards that you can get if you have a little bit lower credit score or have some issues, okay? So an unsecured card is one that you qualify for with your credit score, and they just give you a credit card and you don't have to put a deposit down, right? A secured card means that you've got to put a security deposit down, right? So if you're opening up, let's say a $200 secured card, you're going to give them $200 and they're going to put it in a little account and save it aside and give you a credit card equal to that amount, right? Okay. Now, there are lots of banks that do secured cards that as a part of their program, smaller local banks and credit unions. They will check your credit though. And so there are some cases where your score might be too low to even get a secured card at your bank. In fact, we had a kind of a stubborn client one time that said that, I've been everywhere and trying to get a secured card and I keep getting turned down. I don't know what you're talking about, right? Mm-hmm. Of course, we didn't tell them to go to the bank and whatever, because we kind of knew with their score where they weren't going to qualify. And all of the times that they applied, they got another inquiry, right? And that would probably even drop their score even more, right? So the one that we recommend is called Open Sky Visa. Here's why we recommend it, because they don't pull credit. They just want to see that you have a source of income and a bank account, okay? So that's the difference there, right? So you could have no score, right, and still qualify for Open Sky Visa. And then you also don't have an inquiry that goes on your credit report, okay? But on the flip side of that, they report to all 3 credit bureaus. So although they're not going to pull your credit to get started, they are going to start reporting to all 3 bureaus. Now there are some secured cards that don't report to all 3. So that's one of the reasons why we like Open Sky Visa, because it could help all 3 scores to improve, okay? Another good thing about Open Sky is that their interest rate is pretty reasonable for kind of a high-risk credit card. It's like around 19%. There are some some unsecured cards that have higher interest rates, I think. And their annual fee is very low, like $35. So if you have to recommend something, we like to recommend something that's not, gouging them with super high fees and super high interest rates.
I have a question.
Yes,
Is this a card you're gonna wanna keep forever?
No,
And when you're done with it, do they give you your $250 back?
they do.
Okay, that was my
They
understanding.
do. Mhm.
And I have another question for
Uh-huh.
you. Is there a certain, card that has better interest? Like, I've had people ask me how they decide, maybe they want a transfer balance, they want a lower interest and all
Mhm.
that. Is there certain cards that do that?
NerdWallet is a good website to look to shop around for credit card interest rates. Creditcards.com is another website that is pretty neutral. NerdWallet might have a little bit more advertising on it, but I think creditcards.com is pretty neutral. And then, Credit Karma also contains a lot of offers that you might qualify for in their services there. So that's a good way to shop around. Just be very careful, because they're opening up a new credit, right? And then closing an account may not be beneficial to them. So if they're gonna try to transfer from a 19 down to a, whatever, let's say 2.9 or something like that, like they got this amazing interest rate. But then they close that, right?
Right,
That could hurt them. So,
So could they transfer the balance and then just keep that card open with the $10 on it?
yes,
Okay.
yeah, see, yeah, that would be the way to sort of maximize that. And they would see the new credit hit at first, but then it would gradually go down, yeah.
Now, would that be a right credit card to recommend for buyers who don't want a credit card at all?
If there's someone with,
Sky Visa.
with no credit cards, this is a great place to start.
Right, okay.
And the limit is based on how much you put in. I think you can do up to a couple thousand, but you know, I really recommend that 200, 300 sort of a thing, because then it's really small,
Okay.
and not a big, you know, capital outlay, you know, for most people. So, and that's the website there, openskycc.com. But if you just Google Open Sky Visa, you'll find them. Okay.
How,
No, go ahead.
how do you spell nerd ball?
Nerd Wallet.
Oh, nerd wallet.
Nerd Wallet.
Spell it, please.
NERD
Mhm.
WALLET
.com.
.com.
Thank you.
You're so welcome.
Mhm.
Another way to help build credit is obviously by having an installment loan of some type. You know, and that's kind of what I meant, like your student loan, even though you're like, when am I ever gonna get this paid for? Might really help you to grow your credit if you did have a student loan, even a small amount, right? Now, rental reporting is something you may or may not have ever heard of. So rental reporting is the ability to report your rental payments at an apartment complex or a property management company as a trade line on your credit report, okay? And there are some ways to do it. There's a company called Rental Karma, but we like this one called Rock the Score, and so we kind of are an affiliate with them. And if you want that link, I can send it to you, but that's how you find it. I know it's kind of wonky. rockthescore.com /RTS, you know, elevate-my-scores. It's a long website there. But that's how you would get to sign up with them. So what you do is you sign up and they look at your lease or your rental agreement, and then for a small fee, like $8 a month, they report that payment as an account on your credit report. Okay?
Is it a rental account, is that what's reported
Mhm.
as?
It says self-reported rent, and it kind of factors in as an installment, right? And if it's for someone who's really needs more credit history and more length of history, you can upgrade their services and they'll look back for the past 2 years and then grab the last 2 years of history as well.
Is that only for the people who are renting or for the landlords also?
It's for the people who are renting to report their payment history as a trade line on their credit report.
All right.
And there are only, you know, not everybody would really benefit from this. Now, the catch here is that they only report to Equifax and TransUnion. Experian doesn't allow this to be reported. Experian actually has their own self-reporting thing called Experian Boost. Have you guys ever heard of that? There's been a lot of commercials. There's about it. And so it allows you to report only to Experian your utility payments. So they do the same thing, but they scan your bank account for the times that you've paid your utilities, and then that gets reported as a self-reported utility account on your credit report. And their, you know, commercials about it say that people get 20-30 point boost, you know, to their credit score. I would just be cautious if it's someone who's trying to buy a home. We've heard from a few of the loan officers that we've partnered with that they've actually had to go in and get that data removed because it affected DTI or something else in the loan. So just be careful. But if it's someone who is not necessarily a home buyer just yet, maybe they're trying to get, you know, they have different goals or whatever, it could be a tool. Or maybe they already are in a home and they just want to, you know, improve their credit, whatever. But I would be cautious about that.
What
So.
was that again?
It's called Experian Boost. And if you go to the Experian website and, you know, search for that, you'll find it. Yeah.
Okay.
Yeah. But then when it comes to, you know, the mortgage company, how that affects the mortgage, just make sure you talk to the loan officer too. So I think it's kind of we're recommending it only on a case-by-case basis, you know, and not just as a blanket, hey y'all, go do this kind of a thing. Okay. Now we're going to talk a little bit about identity theft and errors, because one of the things that, you know, by looking at your credit report on a regular basis, You might see things on your credit report that you say, I have no idea what that is. You know, that was from back when I was 10 years old. How can I have, you know, how could I have that? Or that doesn't make any sense. I've never had an account like that, right? So 70% of credit reports have something incorrect on them, right? And it's usually something that's detrimental, some sort of error in reporting. Now, we tend to get more upset about times that our account has been compromised, or you know, something that's more of a theft related issue, okay? And that is definitely something that at times can affect your credit report, but all of that, you know, can be helped by just that regular monitoring of your credit. And I talked before about a credit monitoring service that we like to recommend. This is the one that we use called Identity IQ. If you Google them, you'll find their website, and they have a monthly fee. You can get a little bit lower monthly fee if you sign up through our website. So if you go to elevatemyscores.com and click on check my credit score, you can get to Identity IQ and get $10 off their monthly fee. So it was, I think, $29 and now it's $19. But anyway, so Identity IQ shows you all 3 scores. So all 3 credit bureaus worth of information, payment history for 2 years. You've got phone numbers and addresses for everybody who's reporting on your credit report. It's a really good information. They also include fraud protection insurance, like $1 million of fraud protection coverage, should you need to, you know, go down that route for identity theft purposes. And they alert you of new things reporting on your credit report. So now let's talk a little bit about identity theft, times that our credit gets compromised. So mail theft and dumpster diving, those are pretty self-explanatory things, right? That's where someone actually steals your mail to get a credit card number, right? Or, you know, my brother, his wife had her new card that was stolen out of the mailbox, you know, that was mailed to them, right? That could certainly happen. Dumpster diving is where someone is trying to go through stuff in the dumpster to find account numbers. That's why you should always shred anything that you throw away that's got, you know, account numbers or sensitive information on it. Pre-texting is not something that you do before you send a text message. Pre-texting is using information that you know to gain more sensitive information, like to pry. So a good example of that is calling someone that you know is an older adult and saying, hey grandma, I'm in jail and I need $7,000 bail money. Right, have you heard of those types of senior fraud? My mother's gotten a phone call like that the very first time, just panicked her to no end, right? She called me right away and said, who's Robbie? It's like, he's at Georgetown High School. Why? Okay, well, but you know, she was with it enough to ask questions, you know, like, what's your name? What's your mother's name? And they couldn't answer. They're like, oh, grandma, you know, right? You know, but you don't sound quite like yourself. Oh, I broke my nose, you know, just they kind of tried to play along and to convince her, you know, and she was able to stop that. So that's a real serious thing. Another type of pretexting would be like the Microsoft phone call, where supposedly Microsoft is calling you to tell you that your computer is, you know, whatever. I got one the other day that said it was Apple support. Have you gotten that too? And they said one of my iTunes accounts, you know, was compromised. And I said, hey, which one? And they just kept changing the subject. Well, which account are you talking about? Because I know there's like that many different iTunes accounts in my house, like, so they could never tell me. So I just clicked hung up, right? So, you know, using, like I said, using information they can verify to gain financial, you know, gain, or gain the information that they could misuse. Shoulder surfing would be, you know, that someone could see over your shoulder and watch you type your PIN in and then later steal your card, so they could have both PIN and card. Phishing is a message that you get with a link, you know, like from Wells Fargo, click here to, you know, verify, you know, something like that. You ever gotten one of those kinds of text messages? I got one the other week, except I don't have a Wells Fargo account, so I knew it wasn't me. But, you know, somebody just sent that blast out hoping that they could find someone that does, that would click on there and give them their login information, right? So, skimmers are devices on gas pumps. You guys have heard about that, right? I think the media is kind of helping to get the word out about skimmers, that they're something you need to be aware of. and how to, but I still hear, no matter whether you use it as a debit card or a credit card, they can still get it, I don't know. But just, checking your bank account every day can be something that would be helpful with that. Breaches are where a merchant account has been hacked into. A few years ago it was like Home Depot and Target were, continually being compromised. Of course, a whole credit bureau was compromised. The teacher retirement in Texas was compromised, and all of their data was dumped. So, yeah. Ransomware is where someone, like you get a virus on your computer and they lock down your device and demand a ransom. I had a realtor in a class one time that said that had just happened to him, and he couldn't get onto his laptop to do what he needed to do to do his job. He had to go just drop the whole thing off at Best Buy and cross his fingers and hope that they could get it off, and I think they did. But now wire fraud, this is something that has recently been a really big issue. Down in Austin, there was a client that had funds diverted away from the title company due to a message that they got about where to wire instructions, but it was actually fraudulent. So the FBI got involved, and there was a very large investigation involved with that. But I think it's happened more than once. So as you as you do business and work with title companies and mortgage companies, just be very upfront with customers that they should never just follow email instructions that say wire your funds here. It should always be related to a phone call right. So, okay. Now, as common and as that we feel like that is, errors are way more common. So these are just flat out mistakes on your credit report that don't have anything to do with theft, right? And when we get really mad about theft, right? And feel like we've been violated. But these mistakes of cross-reporting are definitely more common. So if you live if you have a similar last name in the same zip code in a highly populated area, you're gonna have cross-reporting. So if you have a common last name like Smith or Jones or Martinez or Lopez, right? And you live in an area where lots of people live, you're gonna see cross-reporting, just things from other people's credit report just popping onto your credit report, right? For no other reason than that's just, kind of a glitch, right? Juniors and seniors in families have a lot of cross-reporting issues. If you know someone that's a junior or a senior, they might have dealt with that. We're also seeing it just in family members that have similar names, right? Like, like Mark and Marcus, right, are very similar, right? And they probably lived at the same address, because they're family members, right? Or same first name and last name, but a different middle initial, in the family. They decided, so can be a lot of cross-reporting that way. And this last one is a really weird one. And people kind of look at me like, you are crazy, but we've seen in credit reports that have had this on there. So it's called a Social Security mismatch. So this is where if you have 4 letters in your name that match with 7 out of 9 Social Security digits, your files will merge. Yeah. So this is why in families they don't issue consecutive number Social Securities any longer. They used to a long time ago. If there were 2 siblings and they went down and got the numbers, they would be like 1 digit off, right? So their numbers would be virtually the same, and then they would have lots of cross-reporting that would happen. So now they're like, whoo, all over the place, right? And that's good because it kind of helps protect from that. But we had a client one time named Roberto, and he said, I insist that this item right here is identity theft. Someone has stolen my identity. They've opened up this $5,000 Chase card, and this does not belong to me, right? So we started looking at that Chase card. It was only about 20% utilized. We've been making payments month after month after month after month after month, right? So this was either the most honest thief or it was some kind of reporting error. And as we looked, this belonged to someone named Robert, and their Social Security number was 1 digit off. Yeah. So it was not identity theft, it was this social security mismatch, right? Now probably this other Robert guy probably had Roberto's stuff reporting on his credit report too, whether he was looking at his credit report or not, right? So we, you know, actually looked, and this was poor Roberto's best account that he had on his credit report, so we waited a little bit to get it removed to help. Maybe I should have told you that. But yeah, so that is something that could happen. Okay, let's talk about negative items on your credit report. So these are the kinds of things that we see on a credit report that are negative. Collections, bankruptcies, bankruptcy items, that's just an account that has been through the process of a bankruptcy. It's not the actual, you know, court action, but it's something that has gone through the bankruptcy and kind of come out the other side, right? Charge-offs, profit and losses, inquiries, tax liens, judgments, medical collections. We're seeing so many medical collections these days, just from how insurance is billed and how complicated it is for people to understand. Of course, divorce-related issues like we bought this thing together and now they're not making the payments because they got mad or whatever, you know, that kind of a thing. Identity fraud, like we talked about, foreclosures, repossessions. I should put short sales in that category as well. And of course, any and all late payments are all considered to be negative items. Now this is where companies that do credit repair, like us, we roll up our sleeves and get to work. This is what we can help get removed from a credit report through the process of investigations using the Fair Credit Reporting Act. And in the case of medical collections, the HIPAA privacy laws, because there are hundreds of different points of information that they're supposed to keep on file about those things in order to legally report them. In many cases, they don't. So we just have to know what questions to ask and keep persisting at asking those questions until we can poke holes in the case, and then legally it can no longer be reported. And that's how we do what we do. So that just kind of can tell you. Did you have a question?
No.
Okay. All right. Now let's talk about collections. And this is another one of those things that really seems counterintuitive. Okay. So when I say collections, I mean an account that's gone to the collections department at the credit card company, or it may be a third party is helping to collect on it, or you know, like they're just like the collection agency, but they're still being, you know, paid back to the original creditor, or in some cases it actually gets sold off as bad debt, and then that fourth party, I guess, in a way, is collecting on that outside, and they're just trying to recoup what they bought for it. Okay. There are lots of different types of collections. You can have a credit card collection, you can have a student loan collection, medical collections, utility collections, cell phone collections, you know, auto loans. There's kind of goes on and on there, and they all have different impacts. Okay, and we talked about medical collections. So when a mortgage company is looking at a credit report, and let's say, you know, someone's got a 639 credit score and they've got 5 medical collections on their credit report, and that 639 is keeping them from going from here to that better rate that they could get at 640, or that better program, right? You know, addressing those medical collections could help them, right? Now, the good thing about those medical collections is they're not counting them in the DTI as a bill that they have to pay, right? So they're not going to affect underwriting. So if your scores are where they need to be, you really don't have to address them, right? You can just kind of let them sit there and fall off or whatever. So I'm not telling you not to pay them, but understand the impact of them, okay? Like I said, medical collections have the least impact because they don't affect DTI. But unfortunately, they do affect your credit score, okay? So even though you know, they're not going to be as important, you know, in doing the loan, but if they're holding your score down, then they can really be something that we need to take a look at. Okay.
Let me chime in on that real quick.
Yeah.
All of a sudden, this has never been this way before. I have seen about a 75% positive rating on people calling their medical collections and saying, "Hey, I'm going to send you $500 right now if you'll delete this account." And I've seen a ton of them come back, and they will. It used to be nobody would ever do it. but for whatever, now I've only seen it on medical, where about 75% of them are deleting them. And what you're gonna need to do, if they decide to do that, you need to have them send you something in writing stating that it will be deleted. It's been
Before.
Right.
Before
Don't
you
just
pay it.
Yeah, don't just send out a whole bunch of money or whatever.
Right. Now, so and that could be their way of sort of combating against the, you know, people like us that will get it removed without
Right.
it being paid, and that could be, but sometimes that's a bait and switch. So just, you know, be very careful about that, because when you go to pay that medical collection, your score will drop.
It's like picking a scab. It
Yeah,
is. It really is.
So your collections affect your credit report the most when they first report, okay? And then the older the activity on the account, all right, then the less of an impact it has on your credit score, okay? So if you have a 2-year-old collection and they're finally bugging you enough and you decide to make a payment on it, guess what? You've restarted that clock. And now it's affecting your credit score as if it were a new collection, okay? So that's why I say when you make that payment, you know, you're going to see a drop in your score. Now, if it's a chess game that you're playing to get from A to B, and you're fairly confident, or if you're contracting with a company like us and we're gonna go after it, then, you know, that might be something that could help. But generally, they're the way lower on the totem pole for us to, you know, to be concerned about, because they don't affect the DTI, right?
Why does the score drop?
It renews the activity. So the effect of your score is on how recent the activity is. And every time you make a payment, you're resetting that activity clock.
So if I have a client that, because they said that they have one that in 6 months, it'll be 7 years and it would kind of fall off. But if they're trying to get a mortgage right now, would they wait till, if they're wanting to pay it off? Or should they pay it off or just let it fall off?
I would want to see, like, what's the amount? If it's a $200 collection or
They said it was 200.
okay, then it's not affecting their DTI very much, right? Even a partial payment on that wouldn't be considered, and a 6.5-year-old collection is not affecting their credit as much as a 6 month.
Does he need his scores to come up?
Well, he doesn't, but he just wants to get his credit, like.
Tell him don't do anything till after the mortgage is closed.
Yeah,
Okay.
yeah. I would
And
say.
so if he did, end up, like, say in 6 months, if it does fall off, would he or should he pay it off or just leave it alone?
Leave it alone.
Okay, and then he can get it taken off, or how?
Okay,
Does
so.
it fall off in 6 months? Does it automatically happen?
No, it's not 6 months, it's
I'm
7
sorry,
years.
7 years.
So negative items can legally report on for 7 years, that's a
Now
statute of
bankruptcy's 10?
limitations. Yes.
And so when it falls off after 7 years and they sell it to somebody else, does it come back?
It can,
again?
it can, it can. But usually on something that's small, like $200, we don't see that very often. If it's an apartment collection for $2,000, yeah, probably.
Okay.
That could be something that, you know, and that's another good point. So there are, I see a lot of credit reports with housing-related collections too, you know, like they broke their lease and they said it was fine, they said it was gonna be fine, but they charged it off anyway, right, you know? And they'll get an apartment collection from that, and that can be, so a housing-related collection can look, you know, whether, you know, how much it affects the score or the amount of it, you know, notwithstanding from underwriting, it looks like you don't have housing stability, you can't pay your housing payment, you know, you're getting yourself in.
So should that be paid off then?
Now that's a situation where we would actually recommend negotiating a settlement. And in very many cases of those collections that have persisted for a while, they're willing to take a 30-40 cents on the dollar settlement. And I'm not saying contract with like a debt settlement company, but just call up and offer to negotiate on your own. And very often people can accomplish that just by kind of playing poker with them a little bit and saying, you know, I'd really like to settle this matter, you know, and offering a settlement. There are some companies that we know very easily will settle. Like First Premier Card, if you ever have someone that has had a First Premier Card that's gone to their collections department, they will very easily settle for 20-30 cents on the dollar. And then at that
Does
point.
that hurt your credit score?
It can, but then if you're playing, like I said, if you're playing that chess game and then intend to dispute it after it gets settled, then, you know, the end result is better, you know, than having an unpaid collection on your credit report even, you know. So that's why I say, like, you've gotta take a hit in order to get, you know, take 2 steps backward in order to take 4 steps forward, right? In order to get that. So that's kind of what Christina was recommending with some of those medical collections. If they pay it, it's probably gonna drop their score. But if they're giving them a letter assuring them that they will, you know, stop reporting, then it will help their scores increase, so.
Do collections and charge-offs hold different weight?
So what happens a lot of times, let's say Verizon is one we see a lot, you know, that they will, there'll be a collections item for Verizon, but then it'll be charged off, so it'll be double reporting. So there'll be whoever they sold it to, let's say like Jefferson Capital or whatever, you know, so they'll have that collections item from Verizon and a new, you know, collection from that third party. So that's kind of where it goes into that charge-off status, you know, is where, and charge-off just means that they've written it off, right.
Because
And
we
they
find,
often sold
I
it.
see sometimes when people have, you know, kind of marginal credit, that one of the conditions of the loan will be, if your collections are over $2,000, they need to be paid at closing. But that doesn't, they don't take into account the charge-offs. I have a girl that's currently paying student loans and has over $100,000 worth of student loans charged off. So may right.
It's probably because they're double reporting, maybe, and she restructured them, so the trade lines are duplicated possibly.
Maybe.
Those are the trade lines from where, so a lot of times with student loan debt, you know, if they've gone into default on the student loan, but then they call up and say, hey, I'd like to get started on a repayment plan, that they will, you know, maybe leave those in that charged off state and then open up a new trade line. And then as long as they make a series of monthly payments, might be 9, 12 monthly payments, and then they'll re-age that account. But sometimes they'll leave that old stuff on there, it really depends. And that could be why, that they've taken that and restructured it into a new trade line. And just
Killing
left
her
it,
score.
is it?
Yeah. But I mean, it's just weird because like I've never seen Discover student loan, but she's got one down here that's $54,000 and one up here that she's paying perfectly, never had a late pay.
So it wasn't a government loan?
They have a no.
Yeah.
No, and there's no.
Interesting.
Yeah, it's very, I've never seen that.
So, but a private student loan is not gonna have the underwriting impact that a government student loan.
Right,
So
of
if you have
course.
a government-backed loan of any kind and you go into default on it, you can't get another government-backed loan, right? So if you have a government-backed student loan and you default on that, then you can't get an FHA, VA, USDA loan, that kind of thing, right? So that's the importance of that.
A foreclosure, I
Mhm.
knew was 7 years, right?
A foreclosure to stay on your credit report?
Yeah.
Yeah.
And, you said something about rent.
You can-
$2,000 rent.
You can have a housing collection, so like, let's say an apartment complex or
Mhm.
property management, if you break your lease,
Mhm.
or if there's some damage that they can't collect on because it's greater than your deposit, they can file for collections. So, you know, we see that a lot, especially with broken leases, well, they'll charge, and send it to collection agencies to try to get that.
Okay, so now, and they can zap you for 7 years on the rent?
Sure, just like any other type of collection. Yeah. So, right. So I guess the big picture here is that knowing if you pay a collection, it will drop your scores. There are times that you do want to pay it. There are times you do want to negotiate a settlement. It's much easier for us in our company to get a paid collection removed because they don't have any more skin in the game. They're not interested in trying to collect on it anymore. So there are times, you know, like Christina talked about, well, we'll say, let's settle this one. because we know we can get it removed, that kind of thing, so.
So if I negotiate a settlement with the collection
Mhm.
agency, would that have a less impact on the score?
It will still be, it'll close the matter.
Yeah, it'll close it, have a less.
And
less-
it'll renew the activity, so it's
Right.
still gonna drop your score, whether it's paid in full or, negotiated. Now, in some cases, depending on the collector, if you negotiate a settlement, they can 1099 you for the balance that they
Right.
are writing off, so that it can be an issue too.
So what happens in case if they said 1099, it's an income, right?
Well, if they wrote, if it was a $4,000 collection and you paid half and they
Right.
1099 you for the other half,
Yeah.
that you just have to report it on your taxes.
Yeah, that's fine.
Yeah, that's kind of how that works, but, so, just understand the impact of paying collections. I'm not here to say, don't pay your collections.
Right.
Right, would not do that, but like Christina said, like at closing or, just understand how the impact of that will be. And if you have a question, call your loan officer. We did have a client one time that had and very often when you do a mortgage inquiry, you'll get new things that'll pop on your credit report that you haven't seen before. Had a client actually from the Central Texas area that called her realtor and because she got pre-qualified, and then when they ran the credit right before closing one more time, a new collection had popped off. And this is an older person that had a credit score like yours, and it was an AT&T equipment return collection. And it dropped her score to 690 from 800 something probably. And she was just in tears because, and it wasn't reporting this whole time. They never reported it until right at that last little scan right before closing. And so she had to decide, well, do I just close with a 690 and take this terrible interest rate that I really don't deserve? And then refinance later. So it was a hard phone call, and she's like, why do people do that? Like, I don't know, I'm so sorry. But it happens very, very often, right? But in that case, if she had just paid it, her score would have gone down even more. So, a call to your professional that's working with you is really important. And that's why building trust with the people that you're working with is a really important thing to do, because they're gonna rely on you, to help them navigate through this situation, and if you don't know the answer, call somebody you think that can help you, because you'll hear a lot of that, so. Well, I'm gonna let Christina talk briefly just kind of about her programs and tell you a little bit more about Affiliated Bank Mortgage, and then we'll wrap things up.
How many days on the rental? 30 days, when you don't pay your rent? How many days?
When is it considered a late or?
Well, I'm not talking about a late rent payment. I'm talking about like when you move out and they're charging you, because you broke your lease.
Oh.
And you didn't fulfill your lease, or you damaged the property and they need to collect more
Okay,
than
that
your
kind of
deposit. That's usually what we'll see.
Okay,
More
so you-
often than not, it's a broken lease.
Right, but they won't get you in 30 days for not paying
No,
your rent?
no.
Okay.
No.
I don't see it very often.
Good question.
Mm-hmm.
Okay. All right.
I get a lot of questions after this about a lot of credit and stuff. I mean, if you have any questions, just give me a shout. A lot of times, there's so many things it's like, oh, I've never seen that before, or I've seen, some things are more common than others. When it comes to credit reporting, make sure that what you're telling them is accurate. I hate to sit here and tell you guys this, but I've been in this business for 20 years and I've seen it all. Loan officers will tell you the craziest things. You've got to build a relationship with somebody that you're going to be able to trust. Whether that's me or Joe Blow down the street, you need to be able to call somebody that you know that they know what they're talking about, that's not afraid to say, hey, I don't know, let me call you back. Because there's so many people that will tell you what to do and what not to do. And like an example, go pay that $12 collection off. Well, now your score that you didn't like that was a 680, well, now it's a 580. Credit scores have a lot to do with interest rates. A lot. People will say, well, my sister's friend's uncle's brother got a 4.5. Okay, well, his credit score is 890, so it's a big difference. You know, I just did a lady, she was, buying a $362,000 house. She's putting $75,000 down. Her credit score was 787. His was 554. Beautiful loan till you throw that 554 in there. You know, her interest rate stunk. And there was nothing, I mean, I gave her as much as I possibly could. Also, a lot of people don't know this, we all have the same interest rates. Everybody does. If somebody's telling you, oh, I can get you a 3.5, like your mama said, ain't nothing in life free. Nothing. So when somebody says that they can give you a crazy interest rate, I tell my customers all the time, good, send that to me in writing. Because if they're willing to send it to you in writing, my boss will match it. 99% of the time they can, because they're full of it. You know when that loan estimate goes out in the beginning, you know, I mean, people do all kinds of things. Just be aware. Don't be afraid to ask. It'll get you a long way. It really, really will. And find you somebody that you can trust, that you can call and ask the dumb questions, and the little piddly stuff, because it matters. You know, there's lenders everywhere. And I know a bunch of them down in Bell County. I know them in Bosque County. They're everywhere. My advice to you is just find somebody that you trust. And don't think that the one you trust means that he can get everything done, because maybe he can't. You know, I see a lot of times people get upset, well, you can't get this done, blah, blah, blah. Well, you wouldn't write him a check either. Just saying, you know what I mean? There are instances where, you know, the guy needs to do a little bit of work. And I get it, everybody goes through divorce and bankruptcy, but you can come out of that stuff. You can come out of that stuff. If you see somebody that's gonna go through a divorce, you know, you can put all day long that he's gonna get the 1962 Ford, but if it's still on his credit, it's still on his credit. It is. It's still killing it. And maybe, you know, they can't get sued for it or whatever, but they're still liable for the payment. The payment's still reporting. It's still killing them, all those things. So that's just my advice to you, is find somebody you trust. They're everywhere. They really are. So don't be afraid to ask somebody, and don't be afraid to question it.
Do you guys have any loan program questions? If you understand, kind of unpack what those acronyms all mean there. Good time to ask.
Everybody, is
Ask
anybody
an
using
LO.
T-Shack?
I was just about to ask.
Are you using it? Texas State Affordable Housing Commission?
Yep.
Yes. They are giving
Grants. Yeah.
3, 4, and they'll do a second lien for 6%. So thing with T-Shack is you'll get a 4% grant. They'll bring it to you. It's free money at the club table. They set the interest rate. Right now, I think they're at 5.75. You have to have a 620 credit score though. And so a lot of times, people that need the money don't have this credit score. So you can't have somebody with a 580 that wants to go T-Shack. But they need to take a first-time home buyer class, which is not difficult. I think that last time I saw somebody did it, it was $50. They pay for it. They get a certificate. They send it to us, and they bring a check to closing. It's 4%. Now, the 4%, if you do FHA loan, you know, it'll cover your 3.5% down payment plus another 0.5%. But keep in mind that you still got all the closing costs and stuff. And so what I see a lot of my realtors do is they'll call me and say, hey, Joe's going T-Shack. He's wanting to do the 4%. Can you tell me what the fees are going to be up and beyond that? What's it going to be? Because, you know, he has to pay for your taxes, your insurance, all that stuff. And so you can write your contracts to where the seller's paying the closing costs. Now, like I tell my,
confusing.
it is.
I'm like, I have a contract that I have a client that's doing T-Shack.
It's a great thing.
And it's just like, but I guess you would still put like their down payment and
Their
then
down
their
payment's the
loan
same,
amount
yes.
and all that stuff. So it's like, okay.
None of that changes.
Okay.
The only thing
It just is confusing.
Yeah, the only thing that you're gonna wanna do is call the loan officer and say, hey, they're using T-Shack, what would be, you know, my guy wants to bring $100. And your loan officer should have already had that discussion, but if not, you know, find out, should I put 5,000 seller paid, 6,000, whatever it may be. Now, I am telling people, you know, in this market, don't go in there and lowball that contract and ask God to pay $6,000. You're just not in that kind of market right now. It's just not. Yes, we have been through that, and maybe we will be through it again, but right now it's not that market. If you want him to pay $6,000, you might have to offer 106, you know. So, that's just a discussion that you would want to make sure and have, because, you know, people say, oh, I'm going to use T-Shack. Well, if they don't tell their realtor, and their realtor hasn't had a discussion with the loan officer, you write a contract, everybody signs a contract, yay, borrower thinks they're getting a closing, and they're not paying anything. Wrong. You didn't tell your realtor that you needed them to include $6,000 of seller concessions. You didn't say any of that. So now you're sitting here, you better come up with something, you know. So you need to know if they're going to be using stuff like that. And that's why anytime I get a contract, I call the selling agent and I call the buyer's agent. Hi, this is who I am. We are doing an FHA loan. I have the closing date at this time. I mean, stuff like that matters. I mean, you know, and that's the biggest thing in our business is communication. Nobody wants to tell each other anything, you know. So if you do use that, just make sure you ask how to write the contract. And once you do it once or twice, it's not difficult. It's just, you're not sure of yourself. Yeah. So.
Great questions. Any other questions? I always wanted to ask a loan officer. Here she is.
They'll pick it up tomorrow.
I'll think of it tomorrow. Yes.
I answer
Okay.
my phone, so don't be afraid.
Great. So, what did you learn that you can use in your business today? Tell me one thing.
I mean, like, you hear lenders talking about, oh, you need to get a credit card, and I didn't realize that it was 30% of your credit score that, you know, takes up that portion. I didn't know that you were rated on the credit cards.
Yeah.
I mean, my credit's not bad, so if I can get a credit card, then
Yeah.
that'll help my.
Absolutely. We had a client, two clients, or a couple, and between the two, we got 35 negative items removed from the combined credit report. And she followed our advice, got the secured card, she was clear to close, sailed way past it. He was like 1 point away. And you know why? Because he didn't follow our advice and didn't get the secured credit card. So we had to kind of stop, you know, put on the brakes, just to tap the brakes a little bit while he went and did what we told him to do. Got the secured card, went and bought a tank of gas and made a payment, and then boom, and then he got where we needed to go. So yeah, we've seen it be really a game changer. So, for sure. Anything else?
I think the scoring model was a good education.
It's fascinating, isn't it? Yeah.
It's good, because I didn't know which part affected the credit score the maximum.
Yeah.
The payment history and the types of credit, those two are pretty important.
Yeah. And how one account can affect you here, you know,
All
positively,
over, yeah.
but maybe here negatively, right? You know, so just how that all works, right? Good, good. Well,
The algorithm.
the algorithm, yes.
The difference between
The form, yes.
why do they have this score, and
Mhm.
that one's got this score, and
Yeah.
this one's got that score.
Very good, very good. And Credit Karma's not bad. It just consider the source, right? It's a consumer score, right? Not a lending score. That's what I always
And-
tell some people.
Can you explain the difference between Karma versus annual credit report?
They're all going to be an internet-based score, so they're probably going to be using similar algorithms that are not lending algorithms. Now, actually, annual report, I don't know that they give a score. I think it's just
Yeah,
they do give a score on
once a
annual
year
report? Okay.
For free.
But is it scores or just information and trade lines and payment history?
It's scores.
It is scores, okay,
And
but-
once a year for free.
for free. Yeah.
And I've never used what's that one you
Credit
just?
Karma.
Credit Karma before.
Mm-hmm.
I have a better understanding of how they work now.
It's an app, you know, and a website. It's pretty easy, you know, and intuitive. It's very easy to sign up. So, as you interact with any other app or anything, it's, you know, on your phone. So, but very good. Okay. If you want to know a little bit more about our program and how we could help borrowers, you've got my business card. That is my direct line. You can call me or text me. I'm very good about returning phone calls and messages within 24 hours. There are days like today where I'm on the road and out and about that I won't get, to answer a whole lot of messages today, but it'll be like, tomorrow morning with me and my cup of coffee, and I'll be catching up. So please let me know how I can be a resource to you. We have very affordable credit repair program. I believe that is really based on speed and economy. We want to get people through the program and onto the other side. We don't want to drag it out. We really base our business model on relationships with loan officers and real estate professionals. We want to be on the same team, and helping you get more loans closed, and that's our goal. So thank you all for being here today. I do have a certificate for everybody that's getting CE credit. If I miss somebody today, maybe Jasmine can help me find everybody. Oh, and then these were the names that liked our Facebook page. Would you pick one?
Sure.
Okay. And it is James. Woohoo! James is gonna drink his coffee tomorrow in his fancy Elevate My Scores.
Well, thank you.
Yours. Welcome. Thank you. If you enjoyed the class and if you would recommend it to a colleague, I'll be teaching in the area. I've got a class at Temple Belton Board next week. So it's the same class just offered there, and lots of other places in the Central Texas area. So, spread the word. All right. Thanks, guys.
Well,
thank you very much.
Thank you.